Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Wow, this past week has been a real roller coaster in the financial world, hasn't it?
It really has. A whirlwind.
We saw President Trump's tariff announcements just send these shockwaves through the markets, and honestly, it felt like things were changing by the minute.
Yeah, absolutely. The major financial publications, they've just been full of analysis on these trade developments. For you listening at home, I mean, it's been a lot to process, right?
Yeah.
And our goal today is really to dissect what's been happening.
Exactly. So on this deep dive, we've pulled together reports from, across the major financial magazines, trying to get a clearer picture, understand the immediate fallout, and maybe look at the potential longer-term consequences too.
Yeah, cut through the noise a bit.
That's the plan. Provide some solid insights into what these headlines truly mean for the economy, for your investments. Okay, so let's dive right into this whole tariff thing.
Let's do it. What we've seen unfold, well, tariff roller coaster is a pretty good description, actually. Initially, as reported pretty widely across financial outlets, President Trump announced these, quote, reciprocal tariffs.
Right.
And the immediate market response, I mean, this was really highlighted in places like the Wall Street Journal. It was decidedly negative.
Oh, yeah, you could feel it.
There was this real sense of unease, almost like a rush to get rid of U.S. assets. Some reports even called it a sell everything American kind of mentality.
It was sharp, that reaction. Just immediate fear taking hold.
Totally.
But then, almost as quickly, the whole story shifted. Reports from sources like Bloomberg and MarketWatch started detailing President Trump's decision to pause tariffs.
For most countries, right.
For 90 days.
Exactly, a 90-day pause for most. But, and this is really crucial, it wasn't a complete reversal, not across the board.
No, because the tariffs on China actually went up.
Way up. Jumped to 125%, according to those reports.
Wow.
So, while many trading partners got a temporary break, that escalation with China really underlines the ongoing tensions there. It's a targeted approach.
Definitely. And then after that pause announcement, the markets just exploded upward.
That swing was incredibly dramatic.
Dramatic is putting it mildly. I mean, both Bloomberg and MarketWatch were emphasizing the sheer scale of it. The S&P 500 had its best single day since October 2008.
Since 2008, think about that. Back to the financial crisis.
Exactly. And the Dow. Its biggest rally since March 2020, right at the start of the pandemic chaos.
Huge moves.
And MarketWatch also pointed out the NASDAQ had its best day since, January 2001, the dot-com era. It was just this massive turnaround in sentiment.
It really was a powerful relief rally.
Yeah.
Shows just how sensitive the markets were to that threat of widespread tariffs.
Yeah.
But, and this is an important context for everyone listening, it's maybe not wise to get too carried away by just one day's performance,
Good point.
MarketWatch also mentioned that even after this huge surge, a lot of S&P 500 stocks were still actually down for 2025.
Still down for the year.
Yeah, and hadn't even climbed back to where they closed in 2021. So yeah, the rally was welcome, obviously, but it didn't magically erase all the previous losses or the underlying worries.
Okay, that definitely puts things in perspective. So what do you think was behind this sudden policy shift? What made them announce the tariffs and then, pause so quickly?
Well, based on the reports from various financial magazines, including Bloomberg, it looks like several things kind of came together. One big factor was the significant turbulence in the bond market.
Right, the Treasury yields.
Yeah, they spiked up sharply.
Yeah.
The 10-year Treasury yield saw its biggest three-day jump since 2001. That was highlighted by both Bloomberg and MarketWatch.
And where people may be less familiar, when those yields jump fast, that's usually a bad sign, right? Signals risk.
Exactly. It signals maybe increased risk or expectations of higher inflation.
Yeah.
And crucially, it means higher borrowing costs for businesses, for consumers, for everyone.
Which can really slam the brakes on the economy. I also saw Jamie Dimon's name pop up in some of those reports, CEO of JP Morgan Chase.
Yes, he voiced some serious concerns, didn't he? Worries about these tariffs possibly tipping us into a recession.
Yeah.
His warning, reported by Bloomberg and the Wall Street Journal, probably added to that growing unease among policymakers and investors.
Makes sense. Influential voice.
And on top of that, Bloomberg also mentioned the influence of allies, trade partners. They were actively pushing for exemptions, trying to negotiate deals to avoid getting hit by the tariffs.
So pressure from inside and outside the U.S.
Seems like it. Pressure from multiple angles, both domestic and international.
Okay, so that gives us a clearer picture of the market whiplash and maybe some reasons for the policy U-turn. Let's dig into how different sectors felt this. It wasn't the same for everyone, was it?
No, absolutely not. We saw some really distinct impacts and trends across different industries. Let's start with tech. Within technology, the semiconductor industry really stood out, had a record-breaking day.
The chip makers.
Yeah. MarketWatch detailed how companies like NVIDIA and AMD were just huge drivers of that surge. Their stocks soared. Best day ever, apparently.
Wow, best day ever for NVIDIA and AMD. That's massive.
It is. And for you listening, that probably reflects just how critical they are in global supply chains, right? So any hint of easing trade tensions is a big deal for them. Smoother international business.
Okay, so chips were flying high. But I also saw a contrasting point in MarketWatch about software stocks. They were facing pressure from those rising bond yields.
That's a really important distinction, yes. While the chip guys loved the idea of fewer trade barriers, MarketWatch pointed out that software companies might be more vulnerable to those volatile bond yields we talked about.
How so?
Well, their analysis suggested that if the 10-year Treasury yield hits, say, 4.5%, we could see downgrades in software. Basically, software firms are often valued on earnings expected way out in the future. Higher bond yields mean you discount those future earnings more heavily.
Ah, so those future profits are worth less today when yields are high.
Exactly. Which can lead to lower stock valuations and analysts start downgrading. It just shows that even within tech, these big economic shifts hit differently.
That's a really good nuance. Okay, let's pivot to oil. That market seemed pretty wild, too.
Oh, definitely. According to reports from both Bloomberg and MarketWatch, oil went through a pretty dramatic swing. Initially, when the tariffs were announced, boom, oil prices plummeted.
Fears of a global slowdown. Less demand.
That's the likely thinking. Concerns about less economic activity, therefore less need for oil. But then, after the tariff pause was announced, prices did bounce back somewhat.
But not all the way back.
No, MarketWatch pointed out they're still significantly lower than before all this tariff talk started. And interestingly, MarketWatch also mentioned this ongoing debate about whether oil prices are even a reliable recession indicator right now.
Because of the trade policy interference.
Exactly. The argument is that these artificial pressures and the volatility from trade policy might be distorting the signal. So the recent drop might not be a straightforward sign of economic weakness this time.
Huh. That's fascinating. Policy messing with the traditional signals. What about retail? I think I saw something about Costco.
Yeah, that was in MarketWatch too. Costco's sales, they actually kept growing in March.
Even with all the uncertainty.
Yep. Despite the tariff fears and everything, it could suggest maybe some resilience in consumer spending. Perhaps shoppers are cautious, but they're still buying, especially at places like Costco that offer value.
That could be a slightly positive sign for the consumer then. Now, Constellation Brands, the wine and beer company, they made some changes too.
That's right. MarketWatch reported they made a strategic move, selling off some of their cheaper wine brands, kind of a cost-cutting thing.
Okay.
And they also revised their profit forecast for the year downwards. Came in below what people were expecting.
And did they mention tariffs?
They did. They specifically cited the expected negative impact from tariffs as one reason for lowering their outlook.
So even with the pause later, the initial announcement already had companies adjusting plans.
It seems so. Real, tangible consequences on business planning and forecasts, at least for some.
And lastly, crypto. Bitcoin seemed to react too.
It did, initially. Bloomberg reported Bitcoin saw a noticeable price jump right after the tariff pause announcement.
As a hedge, like a safe haven.
That was likely the thinking, yeah.
Yeah.
A potential hedge against all the volatility and uncertainty in traditional markets caused by the trade stuff. Some smaller coins saw even bigger percentage gains.
But did it last?
Not really. Both Bloomberg and MarketWatch followed up, noting that the rally in Bitcoin and Ether faded pretty quickly. Prices came back down.
So typical crypto volatility.
Pretty much. Highlights how volatile that market is and how sensitive it still is to broader economic moods.
Okay, so it paints this picture of really diverse reactions, doesn't it? Some sectors got immediate relief, others are still worried about the fallout. Sounds like the underlying anxiety hasn't just vanished.
That's a really crucial point to stress for everyone listening. As both MarketWatch and Bloomberg have pointed out, this temporary pause, it doesn't just automatically wipe away those underlying fears about a potential slowdown or even a recession.
Right.
Many economists are still worried about the longer-term effects of all this ongoing uncertainty around U.S. trade policy.
And I saw some investment strategists are actually saying, be careful. maybe use these rallies to sell.
Exactly. MarketWatch specifically mentioned skepticism from some prominent strategists. Banu Baweja at UBS was one, recommending investors maybe sell into these rallies.
Why? What's their reasoning?
Their basic argument is that the negative hit to company earnings and overall economic growth, from the trade tensions, that's still coming, even with this pause.
So they think the market hasn't fully priced in the potential bad news yet.
That seems to be the view. They don't think the potential negative impact down the road is fully reflected in current prices.
And meanwhile, the whole China situation remains a big worry, right? The pause didn't apply there, tariffs went up.
Precisely. MarketWatch was clear on that. While others got a temporary break, hiking tariffs on China signals a continued, maybe even accelerated, path of economic decoupling.
Between the world's two biggest economies.
Yeah. And that has huge long-term implications for global trade, supply chains, economic growth, you name it.
So looking ahead then, what are the key things we should all be watching? What indicators might give us more clues?
Well, both MarketWatch and Bloomberg highlighted a couple of critical data points coming up soon. First, the Consumer Price Index, the CPI data. That'll be really important for gauging inflation pressures. Are they still a major concern?
Okay, inflation watch. What else?
The next Treasury auction, markets will watch that closely to see kind of investor sentiment. Is there nervousness about holding U.S. debt?
Got it.
And as MarketWatch also discussed, just continued choppiness in bond yields could signal ongoing instability and uncertainty. So keep an eye on yields too.
It's interesting. Stepping back, I saw an opinion piece in MarketWatch that compared Trump's trade policy to Reagan's back in the 80s.
Yeah, that was a thought-provoking piece. It basically argued that Trump's approach has some echoes of Reagan's, who also took a pretty firm stance on trade.
What was the core argument?
The idea, according to the author, is that sometimes you need to endure some short-term economic pain, tariffs and stuff, to achieve better long-term economic outcomes. They mentioned Reagan pressuring Japan back then, which was controversial at the time, but maybe led to more balanced trade later, like Japanese car makers building plants in the U.S.
So the theory is that these tariffs, even with the pause, are a way to pressure other countries into better deals for the U.S. strategic pressure.
That's the gist of it, yeah.
Yeah.
The author framed it as strategic economic pressure, trying to shift the U.S. away from what they see as decades of unfavorable globalization. They even pointed to some recent investment commitments from places like Saudi Arabia, Japan, Taiwan, as maybe early signs it's working. But, and this is really important for you listening, it's just an opinion piece, one interpretation. Whether this approach actually works in the long run, that's highly uncertain, still very much up for debate among economists. It's complex, no guarantees.
Definitely provides a different angle, though. So, okay, as we start to wrap this deep dive up, where does this leave us overall with the tariff situation?
Well, as we've covered, it's far from settled, very dynamic still. That 90-day pause for many countries, it creates this period of uncertainty, but also potential negotiation.
The temporary break.
Yeah, a respite for many businesses, consumers. But the key things remain. Tariffs on China went up, and the underlying trade tensions haven't just evaporated.
So for everyone tuning in, the key things to keep track of are:
keep watching that incoming economic data closely. Inflation, bond market activity, those will be critical for gauging the wider impact. Also, just pay really close attention to how markets react to any more news or developments here. The kind of volatility we saw this past week, that could easily continue.
Yeah, expect more bumps.
And obviously, watch for any further policy announcements or shifts on trade from the administration.
Absolutely. It definitely feels like we're heading into a crucial few months where the direction of global trade and how it hits our economy might become a bit clearer.
Indeed. And this whole situation, it raises a really interesting question for you, our listener, to think about. Having heard about the initial chaos, the pullback, the reasons behind it, what do you think the next 90 days hold? Is this pause going to lead to real talks and less tension? Or is it just, a temporary calm before things get rocky again? Definitely something to mull over.
Well, that brings us to the end of our deep dive for today. We'll see you all tomorrow morning with new headlines from major financial magazines.